Hi and welcome to this video where we'll be learning about the terminologies that one should be knowing when it comes to mutual fund. So let me share my screen. So these are the basic terms and names that you should know when you're investing into mutual funds. This is not the entire list, but it covers the important names and terminologies that one should be aware of. So let's start. So number one, AMC and AUM. AMC is asset management company and AUM is asset under management. So let's start with AMC. AMC actually is the company which is managing the money. So company employs a lot of people including the fund manager and is basically in charge of managing people's money. Some of the examples of AMC is ICICI, HDFC. All these are asset management company. Kotak, you have IDFC, you have SBI. So all these are asset management companies. And AUM is the asset under management. So every mutual fund has some money which is given to a fund manager who manages that money for the investors. Now this money that he manages is the asset under management, right? So for example, I'll go back to that website, valueresearchonline.com. Now here we looked at ICICI Prudential Blue Chip. So ICICI becomes the AMC, the asset management company. And if you look at the assets, this is the AUM, the asset under management. So at present, ICICI Prudential Blue Chip has 22,182 crores under this fund. So it's a big fund. And this is basically investing into the blue chip, as the name suggests, right? So this is about AUM. The next is fund manager. Fund manager is actually the person who's actually in charge of the fund and is basically making the decision where to buy, when to sell. All these decisions are taken by the fund manager, right? So if you look at the example again, so these are the fund managers, Anish and Rajat, and it also mentions since when they've been managing these the fund, right? So the fund manager is actually the main person, and we need to know about the brief history of the fund manager, because these are the people who are actually making managing the money, and if they're doing a good job, they're making money for us. If they're not, then they're losing money for us. So as a intelligent investor, we should know the track record of these investors, these fund managers, because if their track record is not good, then maybe we can avoid their funds and maybe look for a fund manager who's actually doing a good job in managing people's money. So that's an important component, and one should do a little bit of research before investing their money. Research about the fund management company, about the fund manager, right? The next in line is SIP, SMP and SWP rather. This is a mistake. Just correct it. Yeah. SWP and STP. Now SIP is systematic investment plan, right? Most of us know this because there's been so much advertisement being telecasted nowadays about mutual fund. So SIP is basically a monthly investment that you make in a fund or in couple of funds. So every month a fixed amount, it can be monthly, it can be weekly, it can be fortnightly. The frequency of this depends on you, how you want to invest your money. Typically it's monthly. So systematic investment plan, every month a sum which is pre-decided gets deducted from your account and it's invested in a fund of your choice. So let's say if you have selected this fund only, ICICI Blue Chip Fund. So every month a certain amount, it could be 5,000, 10,000, 20,000, there's no upper limit. So that would be deducted from your account and it will be put in this fund. See, the minimum investment that you can make in this fund is 100 rupees. Cannot be below 100 rupees. Additional lump sum investment if you want to do, let's say you don't want to go for SIP mode wherein you invest monthly, you want to invest a lump sum amount, you can also do that. And the minimum investment here is 100 rupees only. And Yeah, the minimum SIP amount and the investment amount is 100 rupees only, and the minimum withdrawal that you can do is 100 rupees. So SIP is nothing but a sum which is deducted every month and is invested into the mutual fund. And the next is SWP, which is systematic withdrawal plan. It's also very important. So if you're invested into equities, which is entirely dependent on the market, and if the market comes down, the value of your fund would also come down. And if the market value of your fund actually goes up, the market value of the portfolio goes up, the share price goes up, the fund value would also go up, right? So it's quite volatile. And let's say if you have invested your money, let's say for your retirement, and your retirement is now around the corner, and your retirement is now around the corner, and you want to start withdrawing money, because it could be that your retirement is a year away and you're invested into equities, and in next 1 year there could be a drastic fall in the stock market, and your retirement amount, whatever you have accumulated, can actually go down. It can go down by 30%, 20%, 10%, even 50%, right, in case if there's a crash. So just to avoid that, just as we make a fund by investing systematically every month, similarly we can also do systematic withdrawal, so that when our goal is nearing, then we can actually pull out money from the market, so that that sum is actually not impacted because of the market movement, right? So that's systematic withdrawal plan, wherein you can, just like SIP, it's just the opposite of it. You can specify the amount that you want to withdraw every month, because you don't want a situation wherein you have accumulated the money, and now that when you need it, because of the market volatility, your sum is actually getting depleted. So systematic investment plan is equally important as SIP. And then you have systematic transfer plan, which is not a withdrawal. In this case, a fund, the money is transferred from one fund to another. So let's say you have invested into an equity fund, and as your retirement is coming closer, you want that fund to be invested into safer funds, right? There are different types of fund, we'll discuss that, but let's just say it's a safer fund, and you can have STP going, wherein the sum accumulated every month, a certain sum would be parked from that risky fund, which is equity fund, which is market linked, to this safer fund, right? It would still be invested in a different fund, but in SWP that amount is actually withdrawn and given to you in your bank account. So SIP, SWP, STP, three things that you should know. So next is NAV. Now what is NAV? NAV is again a very important term. It's net asset value. To explain this, let's go back to the example here. Now how is it calculated? For this fund, the NAV there are two NAVs actually. One is growth and one is dividend. We'll come to what both of these means. For now, for simplicity's sake, we would stick to growth. So the value, the net asset value of this fund is 43 rupees 29 paise. And how is this NAV important? So whenever you buy an investment, or whenever you invest in a mutual fund, let's say you want to invest 1 lakh rupees in ICICI Blue Chip Fund, then you would be buying it at this rate. Now, as the value of the shares which this fund holds goes up, this NAV would go up, and as the value of those funds or those shares goes down, this value would also go down. The NAV would go down, right? So, for example, now if you want to invest 1 lakh rupees, and if this is the amount that you want to invest, and the NAV is, let's say, 43.29. So in that case, the number of units that you would get, just like you buy shares, the number of units that you would get would be the amount that you are investing divided by the net asset value. This is the number of units that you would get, right? Now how is NAV calculated? NAV is actually calculated by dividing the number of units, the total number of units that a fund has, the asset value divided by total number of units. So this is the asset minus any liabilities that they may have. So this asset value minus the liabilities divided by total number of units, and you would get per unit value, which is net asset value, right? Now this is significant because, and let me give you another example here. Suppose you have two shares, one is mutual fund A and there's another one which is mutual fund B, right? And the NAV of mutual fund A is 10 and the NAV of mutual fund B is 100. Now your decision to buy should not be based on the unit, the NAV, right? I'll tell you the reason why. Because let's say you want to put in 1 lakh rupees in both. This is the NAV. This is the amount that you want to invest, right? So if you want to invest in mutual fund A, what would your what are the number of units that you're going to get? Here you'll get 10,000 units, right? Similarly, if you're doing something like this here as well, if you're doing something here as well, wherein you're putting in 1 lakh rupees on the NAV value of 100, you would get 10,000 units, 1,000 units, right? So here you're getting 10,000, here only 1,000. So your decision to buy should not be based on the number of units that you're getting, right? That's not the right way of judging a mutual fund. Because let's say if there is a 10% increase in both the funds, right? This one performs 10%, it goes up by 10%, and this also goes up by 10%. So if you look at it, the NAV value would go up by 10%, right? 10 into 1.1, which is 10%. So its new NAV would be 11. Here the NAV again would be 100 into 1.1, which is 10%, 110. Now let's look at the value of the investment. So 11 into number of units that we have. That's how we would calculate our gains. This becomes 110, and if we multiply the new NAV with the number of units that we hold, then again the difference, if we calculate the difference here, this minus this, there is no difference. So 1 lakh becomes 110, 1 lakh becomes 1,10,000 rupees because there was a 10% increase. So the NAV actually holds, the number of units that you get holds no ground for you to buy, because how do you evaluate mutual fund is completely different. But NAV is an important concept to know, right? So the important thing that I'm trying to establish here is, because there's a lot of misconception amongst people here, that in case if the NAV is low, then that's a good investment. That should never be the case, right? I want you to be the smarter lot. So this is actually no way of judging a mutual fund. So NAV, an important concept. Now there's something called exit load. What is it? There is a charge for exiting the mutual fund. Earlier there used to be an entry load as well. So whenever you used to buy a mutual fund, there used to be a charge. So asset management company used to charge for you to enter their fund. Now again we go back to the same example. Well, let's look at the exit load here. See, the exit load here is 1% for redemption within 365 days. What that means is that if you invest in this fund and if you withdraw your amount before 365 days, there'll be a charge of 1%. But if you stay invested for more than 365 days, there would not be any exit load, right? So this is an important criteria again. Let's say if you want to invest your money for less than 365 days, then maybe you should be investing in a fund which does not have an exit load, right? And especially if you're investing into equities, you're looking for long term, right? So in a way, this exit load would also be in a way a deterrent for you to invest for short term. It would help you in staying invested for a long term, but you should be looking at exit load when you're investing in a fund, because you may require money, and if the exit load is a bit too much, then that would just eat away the the profit that you have made, or in case even if you've not made the profit, it would eat away the principal that you have invested, right? So again, an important concept to know. Okay, the next is a dividend and growth. Okay, so we'll go back here. So there are two kinds of funds. Whenever you would see any fund, there'll be an option of growth and the other would be dividend. Now growth is something which does not pay out any dividend. Dividend is nothing but sharing of profit that a fund has made over a period of time. So in a dividend fund, what happens is a fund actually accumulates profit, and since it's a dividend oriented fund, it would pay out the dividend to all the unit holders, right? So that profit gets distributed, not all of it, but some of it gets distributed amongst the unit holder. Now that is not the case with the growth fund. In growth fund, that amount stays invested only, so you get that compounding benefit, right? The money compounds. Let's say if you do not need money, you can definitely select the growth option, in which the money does not come out, it stay invested, and your money gets more chances to multiply, because the compounding effect is happening not just on your principal, but on your increased amount as well. But if you require a regular a stream of income, then maybe you can select a dividend investment option, and there is tax implication to it, and we would discuss that when we would discuss about the taxation, right? So growth and dividend, the NAV would always be different. Now why is that? Because here the profit is included in it, so the value of the NAV actually keeps going up as the fund performs and as the profit roll in. However, in dividend, that profit is getting distributed, right? So the unit value actually comes, the NAV value actually comes down. The unit does not, but the NAV value comes down because that profit is already distributed amongst the unit holders. So there would always be a difference between the NAV of a growth and a dividend fund. If you ask me, if you're looking to build a long-term capital, I think growth is a much better option to go for. There are tax implication and there's some tax benefit as well, which we would cover later. Right, so now the benchmark index. Okay, another interesting thing that you should know. So again, we'll go back to the same fund, ICICI Prudential Blue Chip. Now here you would see S&P BSE 100 TRI, Total Return Index, TRI. So this fund has given this kind of performance over a period of time, and there is a benchmark comparison, S&P BSE 100. So every fund would have a benchmark so that you can compare how well the fund has performed. If the fund has not performed well, then it would be underperforming its benchmark. Benchmark is something that you compare your performance with, right? So since it's a large cap fund, and we'll talk about what large cap is, basically, just to put it in simple words, this fund actually invests in big companies. We saw HDFC, ICICI, Infosys, all these companies. These are big companies, leading companies of India, right? So their comparison is with the index, which is the top 100 companies, right? So how have the top 100 companies performed? And they are, you can say, comparing the two, right? So in case if this fund is doing well, then it would outperform the benchmark, right? So here we see that it has outperformed the benchmark in long term, but in short term it has not outperformed the benchmark, right? Now how do we evaluate that? We'll come to that when we'll be talking about how to build a portfolio, mutual fund portfolio. Now TRI would actually be total return index. So in case if the index has 100 companies, and how has the index performed? So it's not just accounting for the share price going up, it's also accounting for the dividend that you have received. So share companies keep giving dividend from time to time, right? So let's say if you talk about just Reliance, let's say you have Reliance trading at 1300 right now, and after a year it goes up to, let's say, 2000. It does well and it becomes 2000 rupees company per share. So here we see 700 divided by 1300. So our return is 53%. But during this period, let's say next 1 year, if Reliance gives let's say a dividend of 10%, then that 10% would also be added in this return. So the return would actually go up, right? So this TRI is actually factoring in all the other income that the share has given. So basically it'll be a dividend only, and then it's comparing that with the fund performance, right? So you can take an informed decision whether the fund that you have is doing well or not, right? Corpus. Now corpus is nothing but the amount that you have accumulated over a period of time, right? So let's say if you are planning to retire rich, and you're saving up, and you're in your mind that you have that you want to have 2 crores when you invest and when you retire. So that 2 crore would be the corpus value that you want at the end of the day, right? So this is what the corpus stands for, the value that you have in mind. Then you have open-ended and closed-ended funds. So there are funds which are open-ended. You can invest in them any point of time, and you can withdraw money from them at any point of time. So this is an open-ended fund. ICICI Blue Chip is an open-ended fund. Now there are few funds which are closed-ended, right? In an open-ended fund, you can invest today and maybe take out your money tomorrow or day after, maybe after 5 days. There is no restriction. You just need to keep the exit load in mind. But in closed-ended fund, it's closed for a predefined period. Let's say if there is one fund which is a closed-ended fund and it's a 3-year fund. So once you invest in that fund, you cannot really take your money out before this period is over, right? There are some funds which are listed on exchange and you can actually sell them on exchange, but the liquidity there is really poor. So you might not be able to exit. So whenever you are investing, you should keep this in mind, whether it's an open-ended fund or closed-ended. If you're really going for a closed-ended fund, then you need to check whether you can stay invested for that period of time, because in case if you need money, then you might not be able to withdraw money because it's a closed-ended fund. And we would not be going into detail of closed-ended funds because I would not recommend you to go for closed-ended fund. It's rather better that you invest in a open-ended fund, because you have a liberty of putting in money anytime and withdrawing money at any time. So open-ended funds are much better compared to closed-ended funds. Then you have some NFOs. This is a new fund offer. So from time to time, just to attract new investments, mutual fund companies, AMC companies, what they do is they keep coming up with new funds just to attract. They give a fancy name so that investors get attracted and they put in money. And one of the reasons they say is that the NFO, the NAV value starts from 10 rupees. This is one of their main selling point, that NFOs, it's a new NFO. The NAV is 10 rupees and it can actually go up. It can be 50 rupees, 100 rupees, like we saw in ICICI, it's around 43 rupees. There are a few funds where NAV is 100, 200, right? So this is one of the selling points. But as we've just learned, one should not be looking at the NAV value or the number of units that you're getting, because in case if this fund manager picks up wrong securities which do not perform, this would underperform. But if this fund manager does a good job and selects securities which are good and they perform well, the NAV value would go up. And if both the fund manager do an equal job, and if both go up by 10%, there would not be change in the return that you get. You invest 1 lakh in fund A, 1 lakh in fund B. At the end of the year, you have 1,10,000 rupees in both, right? So doesn't really matter, and I would strongly recommend not to go for NFO, because new fund, we do not know the history of the fund. Like we just saw in ICICI's case, in long term it has beaten the benchmark as well. This is not the case with NFO, because it's a new fund. There's no past history that we can actually check. We can check the fund manager's history, whosoever is the fund manager. We can check what are the other funds that he's managing and how have they performed. But it's best to stay away from NFO and invest in funds which have a history where you can actually check the performance, the past performance. Okay, the next in line is expense ratio. Now the expense ratio is again an important concept, because if expense ratio is high, like in the case of ICICI, this fund, blue chip fund, the expense ratio is 1.76%, right? Now whether it's high or not, we cannot really, by looking at this figure, to say that it's a high expense ratio. We'll have to look at the peer comparisons, the other similar kind of fund who invest in blue chip companies, large companies. So expense ratio, we get to see the expense ratio here only. We don't have to go anywhere, right? You can check it here. So ICICI blue chip fund is actually relatively quite cheap, right? The expense ratio, because the expense ratio would continue to hurt even if your fund is not making money. AMC will keep charging you this charge, because this, you cannot avoid this. Even if the fund is not making money, just because they're managing your money, market is not doing what it should, they would keep charging you. So in case if this expense ratio is high, it would hurt you. And you know, a small difference can make a huge impact, right? We'll look at the return when we talk about returns in coming few videos, that these are the few things that one should actually be very careful of, because a small difference can make a huge impact in long term. Let's say if you have a long-term goal of retirement or children's education, 15, 20 years, 25 years, then it can make a huge difference, right? So these are some of the things that you should know about mutual funds. This is not the entire list, but it covers most of it, right? So now let's go to the next video.